Hello and welcome to the third episode of Meet East Capital. East Capital is an active asset manager investing in frontier and emerging markets. In this webinar, we're going to talk about market developments in Q4 and full year 2023 and offer a sort of few thoughts about the outlook for 2024. It's Monday, the 15th of January. My name is David Nichols and I'm portfolio manager for the Global Emerging Market Strategy.
And I'm Jacob Grappengieser, CEO of East Capital.
So if we summarize sort of Q4, what we say is it's a strong end to a remarkably strong year. And if you look at this slide here, you can see some of the numbers with emerging markets returning 8%. If we look at the full year, you could say that the 10% return for emerging markets is maybe not that exciting compared to 24% for developed markets. But I think what most investors probably aren't aware of is that if you take away China, emerging markets returned almost 21%, which is basically comparable with the developed markets in the Magnificent Seven type rally. So I think it was actually quite a strong year for emerging markets. And indeed, if you look at the best performing markets in the world, taking away Argentina, they really were all emerging markets. So you can see here Poland returning 51%, Greece returning 49%, Mexico 41%. So really, it wasn't nearly as bad as sort of as people think. But just to cover the sort of the main market driver there for 2023, and we can see this on slide 3, it was really all about rates, and particularly rates in the US. And you can see here that rates, ever since 2020, really been rising, rising very steeply, topped out at around 5%. And these are historically high levels. If you look back, we haven't seen these sort of numbers since pre-2008. And the implications of this are very, very staggering, both on companies who have higher interest rates costs, sort of less keen to spend and invest, but also consumers who are struggling to repay debts, to get loans to buy houses and things like that. So really, really profound impacts. And I think a lot of the discussion in 2024 is how these high rates are really going to drive and impact economic growth going forward, particularly in developed markets where these rates remain historically at very high levels. Of course, however, in emerging markets, the big question has been about China, and Jacob obviously living in Hong Kong now and traveling extensively. Maybe you can talk a bit about why China has struggled both in Q4 and full year 2023 and what you expect going forward.
Yeah, thanks, David. So I spent a lot of time in mainland China this year, and it's been, I think, remarkably difficult to have a good sense of what's really happening. I get very mixed signals. I think in some provinces, even government officials have had their salaries cut because maybe they didn't, manage to get the GDP growth or GDP growth after the reopening of the economy that was perhaps expected of them. I've seen new factories getting very strong incentives for investing into certain provinces with the local governments helping them. So all in all, the signals are mixed. I also think that the real estate sector, which is somewhere between 30 to 40% of Chinese GDP, if you include it in a broad sense of the word, is not recovering, right? So it's clearly been challenging. You can add on top of this, of course, geopolitical issues. We had elections in Taiwan over the weekend. I don't think there will be a significant change in the relationship between China and Taiwan, but I think we'll see in the next kind of couple of weeks how it all will play out. There might be a situation where the incumbent won the presidency, but the opposition is controlling the parliament, or at least has the most seats in the parliament, which maybe is a good thing in terms of sort of stabilizing the situation with China and not having a more kind of confrontational relationship with China. So I personally don't think that there will be any miraculous recovery of the Chinese economy. Having said that, it's still growing at 4.5% per year. It's still 1/3 of global GDP growth. And our take now has been very much to just focus on the individual stocks. We're trying to find just companies that are perhaps not so much dependent on the general economy. Maybe they are exporting, maybe they are best in their segment, etc. So that's what we're trying to do. The government is trying to boost the economy. It's just doing it with a lot of very small steps. And for example, the interest rates have been cut we now have 4% average mortgage rates because the overall interest rates in China have also been cut. The exports are increasing, and the trade balance, the trade surplus, is at record levels. I mean, if you compare to pre-COVID, it has almost doubled. These are pretty remarkable numbers, right? And those exports are not being led by plastic toys or other things we might associate with China, but actually these are high value products like electric vehicles, different types of machinery, etc. And if we turn to the valuations of the market, so I'll be honest, I think valuations are all over the place. We find some very cheap companies, PE 1.5 to 3. We find some expensive companies. There are different markets. There are A shares, 8 shares in Hong Kong. There are US listed Chinese companies. But again, I think we try to focus on stock picking, so just individual companies. If I just mention BYD, and BYD is the largest electric vehicle producer in China, and I guess there was big news that they surpassed Tesla in terms of EV sales in the fourth quarter of last year. But I think the bigger point is that they're actually double the sales of Tesla if you include also hybrids. And that's, I think, huge, and I'm not sure that everyone understands and knows this. The market cap is 1/10 of Tesla, and the PE is 14 for this year. I think it's 11 for next year, versus 55 for Tesla. The earnings growth is 31%, which is higher than Tesla, 23%. But perhaps most remarkably, I would say that the return on equity is actually also higher for BYD. Tesla is a very profitable company. It's of course a very good company. And I think investors like Tesla because they have a very kind of efficient capital structure, very high margin, etc. But BYD is actually even more efficient and making even a higher return on equity. This is what we're trying to do. And if I hand it back to David, who will speak about some of the other large emerging markets.
Yeah, exactly. And I think one of the other really sort of key topics over the last few years has been the very significant change in the benchmark weights of the MSCI Emerging Markets benchmark, which we and most other managers use. And you can see in this slide that China in 2020 reached as much as a 44% weight in the benchmark. At the start of 2023, it was 32. It's now 27% and falling slightly more. And on the other hand, India was only 8% of the benchmark in 2020. It's now 17% and growing. And as I said, these are trends that we think will continue to grow, particularly India, which we think will continue to outperform on very strong sort of structural growth, but also a very healthy domestic investment retail market. So you're seeing constant retail inflows from the Indian investors that aren't just speculating. You know, when you speak to these Indians, they really believe actually in the equity and the macro story of India, which is really refreshing and encouraging to see. And just briefly to summarize this sort of the India story, you know, I think that this table really shows it all. You're looking at a population of, well, it is actually unofficially the largest in the world now, here unofficially slightly smaller than China, but median age of around 29 compared to 38 in China and America and 44 in EU. And when you combine that with an incredibly low GDP per capita compared to the rest of these countries, I think it's clear to see why the structural growth opportunities are really exciting equity investors, but also companies that are looking to build manufacturing hubs there, partly related to this China plus one sort of sourcing policy. So no, we very much believe in India, and we wouldn't be surprised if I'm talking to you in a year's time, India weight in emerging markets is now well above 20%, 22% or something like that. So let's see. But I think it's definitely a very significant structural shift in emerging markets as a whole. We should also briefly mention Latin America, I think, which is another region we're very excited about. And here it's quite a simple narrative, really. They have the highest real rates in the world. Real rates meaning the central bank rate minus inflation. Mexico and Brazil are around 7%. So there's obviously ample rates for ample room for rates to start falling as soon as you see the Fed start to cut. And so I think that's very exciting. And there's some of our portfolio companies where if they have a 200 basis points fall in interest rates, their earnings would increase by 100% easily. So I think that's very much where we're excited in Latin America. Now, maybe Jacob, you want to talk a bit about frontier markets?
Yeah, so frontier markets, we're doing slightly better than emerging markets last year. They were up 12%. But our fund was up 24%. So I think it was maybe the best alpha we have ever had in our frontier markets funds. We were happy about that, of course. We've always been pointing towards the fact that the volatility and actually the covariance of frontier markets is the volatility is lower and they don't perform in the same way, the same pattern as other markets. So as we can see on this slide, for last year, the volatility was 12% versus 21% for developed markets. So developed markets, almost half the volatility, and that's obviously great. That's exactly what you have in a large kind of diversified portfolio. If we turn to Eastern Europe, so Eastern European markets were some of the best in the world last year. I don't think anyone really expected that, but we had countries like Poland and Greece up close to 50%. And if you look on our funds, they were also some of the best funds, I think, almost in the world. I mean, at least, you know, they would be up there with very, very high returns. So our New Europe fund, which is effectively Eastern Europe, excluding Russia, was up 43%, recording a 13.6% net alpha. So also fantastic alpha or outperformance for that fund. Our Balkan fund, which has more of Turkey in it, they have a 32% alpha. Maybe that's not exactly fair, because I think that there are some questions, you know, about which index to use. But for New Europe, this is a kind of a true and real outperformance that we had versus the index.
Okay, and then maybe just to briefly mention on the sort of traveling and activity side, I think it was another very, very busy quarter. I mean, personally, I spent one of the most exciting weeks of my life in Mexico. I think it's such a fascinating place to visit. Visited some of our portfolio, all of our portfolio companies there, such as universities, a microfinance company where I saw them making their first disbursements to a few sort of new lenders and things in the outskirts of Mexico City, which is really exciting. But we were also on the ground, you know, everywhere in Asia. I think that the list of cities we went to in China is very long, but Beijing, Hangzhou, Shenzhen, Shanghai, places like that. But and the other highlight was this PRI conference in Tokyo, which we actually helped organize. We have a great piece on that our Chief Sustainability Officer, Karin, wrote on that. I think the other final thing to highlight is on the engagement side. We started two actually very significant engagements with large Chinese companies, BYD and CATL. They're a collaborative engagement that we're co-leaders on, focusing on a range of environmental and social issues. Because while we think these companies are great, we do think there's a bit to be improved on the environmental and social side. Maybe Jacob, you could finish with a bit of an outlook.
Yeah. So first of all, we are doing a special outlook session on Thursday morning at 10:30 Central European time. So I would suggest you call in then. But I probably just, you know, point towards growth, right? I mean, you want to be exposed to the high growth of both frontier and emerging markets. India would be growing at more than 6%, and many companies, of course, significantly above that, right? Even China at, you know, 4.5% maybe in a positive scenario. And if you compare that to developed economies that are growing, you know, at roughly a third of this, clearly you want to be exposed to that. But again, more about that on Thursday.
Yeah, indeed. Well, thank you very much for joining us. I think we hope you have found this session informative. And if you have any questions, please feel free to reach out to your investor relations contact. Thank you.